Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, wouldn't it be great if we could turn the clock back? We could probably make a lot of money by investing in the right stocks or revisit financial decisions that we made. While we can't go back in time when it comes to stock investments, we can, however, buy certain life insurance policies with a backdate. To help us understand more about this concept and if there are any advantages to this strategy, we have with us Yashish Daya, CEO and founder of Policy Bazaar. Welcome to the show, Yashish. Tell us, what is this concept about backdating and are there any advantages to that?
The basic concept of backdating is taking a policy between 1 month to 11 months before today. There can, in certain situations, be certain cost advantages to it. See, when you're taking a policy, let's say one is buying a term policy, the term policy at 46 years of age, let's say, is costing about 10,000 rupees per year for the next 30 years. Instead of that, if the policy is taken at the next year, which is let's say 46, let's say the policy costs 11. And there are these age bands at which prices change. Usually 40 to 41, 45 to 46, 49 to 50. There are certain age bands, and it's just that's how it's. Most of this insurance is done in a step function. So if you can take the policy just before that particular step function, then there's a certain cost advantage over a long period of time. Now, the difference between 10,000 to 11,000 rupees is not just 10%, it's 10% over the next 30 years. That can be a significant impact, and hence backdating a policy may make some commercial sense for you.
Right. Just a clarification, what kind of policies are eligible for this? You talked about term insurance, any other?
You could take most of the endowment plans, term insurance being one. Most of your traditional sort of plans, you cannot really backdate a market-linked plan, because in a market-linked plan, you can't really backroll the clock, because people would love to do that, right? It's a great thing. Hindsight gives you perfect vision.
Right.
You can't really do that. So mostly traditional plans can be backdated.
And why would companies actually backdate policies for you? And also, what are some of the advantages of doing that?
As far as the company is concerned, it's basically jam for free. So you're basically saying, I'm going to pay for something which I'm not going to use, because the last 1 year is already over. And of course, there is no risk to providing that cover to you, principally because nothing's going to happen to you any longer. So you're basically saying take 1 year's fee for free. It's as if you were sitting back in time and saying, okay, I will buy this policy, but for the first 1 year I will not claim at all. Why should the company have a problem? Yes, there can be certain additional costs that certain companies may charge. So LIC does charge about 10% extra. And most of the companies do not charge extra for this backdating privilege. It does have a cost advantage to the consumer. It somehow ends up having some advantage to the insurance company, because now instead of a 30-year plan, they're essentially selling you a 29-year plan, because you're backdating by 1 year. So for the first year, there is no cost involved, which is not so bad for the insurance company. There's a bit of complication that comes in. So really low value policies, it's going to be slightly complicated to do that.
But what are the disadvantages?
Well, the disadvantages are you are paying for a period which you're not going to use. So your policy tenure from a 30-year policy is now going to be 29 years. So you're not getting the full extent of your policy advantage. And see, it's only because of a mathematical error that these policies have value, or essentially a step function. They have to use some function, right? They cannot be so precise that every day the premium keeps adjusting. So it adjusts at your birth dates, and hence going just prior to your birth date provides an advantage. So if suppose I am born on 16th September, instead of buying a policy on 17th of September, if I buy it on 15th of September, it's going to be cheaper. So there is an advantage. So the closer you are to your birth date, so just post your birth date, there is some advantage to post dating it. Now, if I'm almost a year away, then it doesn't make too much sense.
All right. So as far as the new financial year 2014-15, it's still early days for that. Let's give an overview to our viewers.
Sure.
How should one go about planning for your investments as far as insurance is concerned? And insurance is an entire gamut of different aspects which affect your life.
Yeah. No. Absolutely. I think any individual should look at 6 pieces at least and see if these 6 are covered before moving on to their assets. So these are basically what you would call personal insurance. I think the first piece in this, and of course it'll depend from age to age, but the first piece in this is what you would call life cover or term insurance cover. The second piece in this is disability cover. Now, life cover pays an individual in case of death, but disability cover pays an individual in case of loss of sight, loss of a limb, loss of certain disabilities which could be temporary or permanent in nature, and that could be partial or total in nature, which have an implication both in terms of earning ability as well as some financial implication and some logistical implication. And hence, insurance policies can cover that. These are called disability or personal accident covers. The third one is critical illness. There are 35 critical illnesses. This includes cancer, this includes brain related diseases, heart related diseases, lung failure, kidney failure, all these kind of diseases. These diseases that are, hopefully nobody gets them, but the reality is people do. And hence, I think the third piece, that's the third one. The fourth one is health insurance, which we've spoken about in detail. The fifth one that people should think about is pension, because pension is a reality that one needs to think about, and most of us don't have a government pension, and increasingly government services also don't have a government pension. I think the sixth one, if you have children, definitely take a child plan as a sixth policy, because as the children grow up, they will require that cost. So, if you go down that sixth route, life cover, disability cover, critical illness cover, health cover, pension cover, child insurance. I think these six take care of your personal insurance.
That's the larger umbrella that one should look at. So how does one cut through the clutter and say, all right, these are the plans that I need to buy, these are the good ones?
I think one's got to start from the objective first. As I said, again, I will repeat those six pieces: term insurance, disability cover or personal accident cover, critical illness, health insurance, pension, and child plan. And whatever anybody is telling you, fixed deposits, etc., put those aside and sort out these six first. Once these six are sorted, do whatever else your insurance, your personal insurance is going to be taken care of. Now, in each one of these, you need to see which company has the right offer for you. And hence, you need to get into the detail of it, figure out what the options are. You do have comparison sites like ours who do help you in this. You can also go to the company's websites. You can also read their brochures. Remember, these are policies you're buying for life. Some of them will become very useful when nothing else is useful, when one is having a really bad time, and they're meant for those times. So please do put in that effort. Do take the time out for them. One of the reasons our overall insurance industry is so messed up is because consumers are not taking a steady interest, and hence they rely largely on a push-based sale, which happens something to do with tax purpose, etc. So which is not going to help consumers in the long run. And hence, please do focus on this product, and look at those six products, look at the options available, look at the matter before you purchase the policy, and avoid surprises in the future. And as I said, comparison sites help you, company websites help you, company brochures help you.
So how does one, allocate budgets for it? Say whether it's for term, whether it's for health. I mean, how does one go about that distribution?
I think
of your
roughly for all six that I mentioned, roughly about 12 to 15% of your annual income should go into all six put together. A bulk of it will go into your pension planning. So out of the 10 to 15%, roughly about 2/3 will go into your pension and child insurance planning, and the remaining 1/3 would go towards essentially your risk planning, which is all around death, disability, critical illness, and health. And if on average a person has, let's say, a 7 lakh rupee income, as I said, about 10 to 15%, so between 70,000 rupees to 1 lakh rupees would get allocated to all of these put together. Roughly about 30,000 would be getting allocated towards your risk-based plans. So there may be about 10,000 going towards a term cover, about 10,000 going towards your health cover, and about 10,000 going towards your disability and critical illness cover. Spread in that ratio would make some semblance of sense, and maybe about 60,000 rupees going towards pension and 15,000 rupees going towards the child planning. Of course, the child planning is only for about 10 years. Post that will be largely pension, and before that also largely pension.
Now, does insurance and market-linked plans work? Does that,
I think for pensions, definitely. For pensions, please take the market-linked plans. They will give you far better returns, and they have very low risk. In fact, do not go for the pension plans. Go for the non-pension unit-linked insurance products. They will create a massive corpus for you. The guarantees that products give actually work against you. There's a paper we've just taken out which explains this very well, that how guarantees work against the consumer. So do go for the non-guaranteed market-linked products, because 30 years is a very long period of time. You will get the right returns. And more importantly, these have very low costs. And best of all, they have the tax advantages which even pension products don't. So when you do receive your money, suppose you're investing 1 lakh rupees today and you get 13 lakh rupees 30 years later on an annual basis, that 13 lakhs can come with tax or without tax. In a unit-linked unit-linked investment product, it'll come without tax. And that's going to be severely advantageous at that point.
So now, given that one has a certain portfolio,
yes,
and how many times should one revisit it, or I mean, what should the duration be?
I think there's stages at which you need to revisit it. I would say roughly about once every 5 years. The reason I say once every 5 years, somebody starts their financial planning when they're about 23. About 28 is a time frame when a bulk of our country tends to get married, and that's one point when you can revisit. About 33 is the point when 1 or 2 children have kind of appeared in the family. So again, another point of revisiting it. 38 is the point when the children are a little clearer about what they really want to achieve in life, and they're getting a bit older. They're about 5-6 years old. You're getting some opinion about where they're headed. Another stage 2 plan, college planning. And there will come a time in about 10-15 years when the children will have left home and they would be on their own, or they'd be settled, and then you would really look forward to your retirement days, etc. So as you look at that, I think once every 5 years is the right time to relook your portfolio and relook what you're doing with insurance. But as I said, about 10 to 15% of your annual income going towards insurance and pension and child planning would definitely help in the long run and would create a very smooth future. It'll not create any bumps in terms of either loss in terms of pension, or not having money for the child to study, or any. So
what you're saying is that really go out there and invest with your eyes open and plan your life out.
It happens to all of us. Yesterday, my own finance team came running up to me and said, you haven't made your 1 lakh rupee investment for the year. And I just put the money. I asked them, there's a particular unit-linked product. I said I would invest in that because from a long-term perspective, that makes a lot of sense. But yes, we all do make a mistake in this. And, unlike me, who has a lot of products available to kind of decide from immediately, a lot of people do not have that full awareness of which product to go for. And in the end, they would fall for whatever is easiest to come by. So yes, planning a few months earlier does help. But more importantly, really planning early in life per se does help. I just want to leave you with a small example. If a 25-year-old starts investing 1 lakh rupees every year for just the first 10 years of their life, so by the time they're 35, they would have collected a corpus of roughly about 25 lakh rupees. Not too much. What is the interest that comes out of 25 lakh rupees? The interest every year is about 2 lakh rupees. Any fixed deposit, anything will tell you that. And this will keep coming forever. So they have the ability to keep investing 2 lakh rupees every year by the time they're 35 for the rest of their life. So it's pretty obvious, if you did not invest for those first 10 years and started investing at 35, the other person already has a 2x advantage over you. And suppose you started investing 1 lakh rupees and that person already has 2 lakh rupees to invest from their corpus. So as I say, it's almost impossible to catch up with the first 10 years of investment. While it seems like there's a time when you have the least amount of money and there's a time when you can have the most amount of fun, but just little investments at that stage can save you so much in the future, because that's the power of compounding.
So that will really make a difference to...
your corpus is 3x. So if you start at 25 and you start at 35, the difference in your corpus, as I just explained, if you're investing 1 lakh rupees per year, is 3x. Because by the time you have reached 35, your corpus is able to make an investment of 2 lakh rupees a year. And you have to just invest the 1 lakh rupees extra, and you have 3 times what the person who starts at 35 has. So starting 10 years earlier can make you 3 times richer. Now, the rest is up to the people. Is it important enough for them to be 3 times richer? Yeah, then do
well,
it.
A lot of 25-year-olds don't really do that, and I recommend that you take Yashish's advice here. But now it's time for your questions. We've got K. Sinha writing from Kolkata. He says, I'll be going abroad for around 7 years. I want to know whether I can pay my premiums through checks from my account there. Yashish.
So they're going abroad, they want to pay their premiums from a check abroad. See, there are a lot of regulations around paying money from abroad. You of course can, but if they have an account here, it'll probably be preferable for them, because I'm assuming even though they go abroad, they may not be closing all their accounts. You have these NRE, NRO options. So what they should ideally do is transfer the money into that particular account that they have in India and pay out of that, rather than totally waiting for paying it directly, because there are some RBI guidelines that do need to be followed, and they do get complicated in terms of paying your premium directly from abroad.
Right, we've got Vishal Khattar from New Delhi. He says, will the amount of alcohol I consume affect the premium of a term life policy? Can an insurer refuse to give me insurance if I consume alcohol?
The simple answer is yes. So it depends on the amount. Of course, there will be a test, and it will be seen whether there is an impact on the liver. But a certain amount, drinking beyond a certain amount may not have an impact on the liver today, but it could have an impact on the liver 3 years later. And the insurance companies are holding a very significant risk in terms of paying out because of a disease which can be caused by your particular actions. So they have a right to be worried, and hence they would either rate up the premium, or they may even refuse. And totally depends on how much you're drinking. If you're a social drinker, no, not really. It's not going to have an impact. But if you're a very regular drinker, and
I think the columns are there, and they actually ask you, how frequently
do you drink, how often do you consume alcohol, and how much do you consume. There are those columns out there, and eventually, depending on what you answer, there is going to be a medical done which would determine the impact on your liver, and the call would be made.
Right, we've got Mohit Gulati from Bangalore. He says, I recently underwent a critical illness treatment. It was covered by my insurer. The insurer paid on time as well. However, I plan to switch to another insurer for better services, and my renewal is early next month. What should I do, he asks.
So see, once you had a critical illness, this is exactly why I suggest everybody start their insurance policy early, because once you get a critical illness, the companies would either make your the new policy very expensive for you, or make it very hard to get or impossible to get, or put certain restrictions in terms of sublimits and co-payments. The fact that you already have a policy, you're very lucky that you already have a policy. You've made the good decision to have a policy. I think you would find it very difficult to change now. And even if your insurance company suggests that you change, I would suggest you do not. Stay with your insurance company and definitely pay your premium on time. Make sure that your policy doesn't get cancelled on any count. Of course, you have the right under the current regulations to apply for a change in policy. Should you wish to do that, apply 45 days in advance. But just in case the decision has not been made in time for your premium payment, do make your premium payment. And I think I don't know the exact nature of which policy you have and which policy you could shift to, and what critical illness you have had. But in general, once you've had a critical illness, you will find it very difficult to get a policy. So definitely don't give up your previous policy before you've got the new one.
Right. Well, we've got Anudati Verma from Mumbai, and she says, I watched your program last week on human life value, but I'm still a little confused on how to decide how much life insurance cover I need to take. So how should she go about that?
So a very simple rule, there can be an income-based approach or an expense-based approach. So if you take an income-based approach, whatever the annual gross salary is, or annual monthly gross salary is, if you're between 35 to 45, 100 times of that. If you're if you're more than 45, about 70 times that. And if you're below 35, about 125 times your monthly gross salary. That's a simple rule of thumb. Add any liability. So if you have a home loan, add that on. If there's any definite expense coming along which you are aware of, add that into the policy. If you're looking at an expense-based approach, just look at what are the expenses that are likely to be there, and do about 100x of that, and you should be fine with that as well.
Right, Ashish. Now that's all the time that we have on this show of Policy Bazaar. But do write to us at ask.policybazaar.com or tweet us at policybazaar_in, and we'll see you next time. Goodbye.